Hello everybody, welcome to this BrightTALK at Summit. We are live from the floor at Inside ETFs Europe in London today. My name is Ryan Ross. Today we have two great panelists on this pensions payouts webinar today. We have Adina Grigoriu from Active Asset Allocation, and we have Nick Firzli from the World Pensions Council. Thanks guys for jumping out and saying hi to us.
Thank you for having us.
Absolutely.
Thank you, Ryan.
So I want to do some quick introductions. You guys can do that much more eloquently than I can. So Adina, can you give us some information about active asset allocation and tell us about your story?
Yeah, sure. So I'm the co-founder and chief executive of Active Asset Allocation. It is a financial engineering company that we built about 8 years ago to do asset allocation models for institutional investors and pension funds. So we basically build them around risk management, and ETFs are one of the ways that our clients use to invest those strategies.
Okay. Nick.
Well, the World Pensions Council is a Paris-based international association of pension funds and think tank. So you could say we're an industry group.
Okay.
And of course, many of our members, allocate across all asset classes, including, passive strategies. And ETFs have been certainly one of the most rapidly growing remits within the passive universe.
Okay, well it's a great segue. Let's just talk about the industry in general. What are the big trends you guys are seeing, and where are we right now in terms of the market for ETFs in the pensions world?
I think it's very interesting, the moment in time, really, because we are here in London precisely to the day 10 years after the start of the great financial crisis, which was really an Anglo-American crisis at the beginning and then spread to the whole world, with, of course, the Royal Bank of Scotland and Lehman collapsing, and a chain reaction. And part of that chain reaction determined the macroeconomic, financial, and political context within which pension funds operate. Why? Because, what as a direct consequence of that great financial crisis, what policymakers did, both governments and central bankers, is they kept interest rates at artificially low levels for abnormally long periods of time.
Like 10 years, right?
Like, 7, 8, 9, up to 10 years.
Yeah.
And that was a way, in essence, to try to buy time and hope for the best, keep the system alive in a way without addressing some of the real issues. And we are still facing the consequences of that easy solution, which is called, quantitative easing, which is another word for monetary complacency. And the direct consequence it had is tragic for many pension investors the world over, because here in England, I'd say pension funds on average allocate 55–60% of their assets overall to fixed income bonds. But if you look at countries like France or Italy or Belgium, it's like 70 or 80% to bonds. And of course, if you're keeping these interest rates artificially low for a very long period of time, you're repressing the returns of pension funds, and on average the returns have been lower than in the previous periods. And so in that new environment, really, where really returns are really compressed, every penny, every pence, every dime counts, and so many pension funds have been really in cost control mode. And I think we'll see later how how ETFs and passive strategies can help control costs.
Okay, so in terms of strategy, Adina, you said you advise your clients on a lot of, not specifically ETFs, which it's so funny, right? We're at Inside ETFs London, and your company is called Active Asset Allocation, right? I'm curious how you advise clients and talk about risk management with them.
Yeah,
speak about that.
Yeah, your point is interesting. I mean, ETFs are just one way of carrying out an investment strategy. So they're very useful to some more than others for reasons that we'll talk about. But when thinking about their investing, pension funds should, first of all, like all other investors, focus on first why they are doing something. So set up a strategy that is coherent with their goals, and then what's the risk of not achieving it, and what are their true risks. Like, many investors still focus on volatility or value at risk or this kind of thing, where their risk is how much they can lose in dollar terms of their investments, or in the case of pension funds that have liabilities, what's their funding ratio? Is it improving or is it going down? And what are their chances to actually be able to pay out to their pensioners later on?
Are ETFs a solution to those issues?
I mean, ETFs are again a way of carrying out an investment strategy. They're one of the solutions, and I think that an investor should carefully assess his own situation before deciding upon carrying the strategy with ETFs or active managed funds or futures via overlays, things like that.
Interesting. So one of the trends that's happening right now is that we're having higher interest rates than we were even a year ago. The Fed's going to continue moving interest rates up. Volatility is lowering, lower than it was in the past 5 years. It's getting much more reasonable. Those have historically been reasons that people use ETFs, right? What is going to happen, or what could happen to the market given these dynamics in general?
I mean, the ETF market is one of the fastest growing markets in the world. So there's no point of it. I read some study, I think right now about 5,000 ETFs available. I mean, that's incredible. $4 trillion US dollars, incredible. So the amounts that are going into the ETFs are great. They're not the same equities versus bonds or alternative strategies, but it's just a huge market, and I'm actually still searching for the reasons why this is happening.
So maybe it's just hype, right? I mean, there's no doubt that there's been a lot of growth.
I mean, it's happening because within the broader context of the rise in passive. So ETFs are just a cost-efficient, nimble, fast way of implementing passive strategies, either classical passive and smart, intelligent, whatever, smart beta or modern passive. But in a way, the beauty of ETFs lies in its nimbleness and cost efficiency. But I think the reason why ETFs have been growing at a very high rate, and I'm on the record for having predicted it in an article. Actually, I think I gave an interview to Inside ETF 7 years ago, predicting it kind of. So I'm happy to see that ETFs have risen dramatically. And what I was saying 7 years ago still applies today. In essence, it's part of the rise in passive.
Okay.
And why the rise in passive? Once again, back to cost. Every penny counts. So pension funds, they have boards. And the board members of pension funds, and also sovereign funds also have boards. I mean, all the large investors, be they insurance companies, sovereign funds, central banks, pensions have boards, and the board members of pensions are called trustees.
They're called trustees.
Yeah. And because in American and English law, it's trust law, right? And in the past, before the great financial crisis, some of these pension funds, some of the board members were sleeping at the wheel. So the trustee is supposed to oversee, examine, assess, and direct and guide what the investment team does. And there was a certain amount of complacency because it was easy to make money if you were a saver or pension fund investor. And suddenly,
set it and forget, right?
Exactly.
Okay.
And all of a sudden, you got the perfect storm. Interest rates free falling initially, and now they're starting to rise a little bit, only in 1 or 2 countries, right? And then volatility, returns go down, and in that world of financial repression, it was a wake-up call for trustees. So they started becoming more engaged, and they started, many of them started taking their role more seriously and asking tough questions to their investment committee or their chief investment officer. And I think the trustees themselves, in that logic of controlling costs, building portfolios in a more cost-efficient, nimble, fast way, they looked at passive strategies and said, maybe that can help me achieve these goals.
Yeah.
And of course, ETFs are easy to understand and easy to use. So if you're a pension trustee, you're not necessarily someone with an MBA or a PhD in finance. So the beauty of ETFs, beyond cost control, liquidity, etc., is that for a trustee, for a layman, it's fairly easy to understand. And then if you can understand it, you can oversee it and apply it better. And I think another reason, which is a driver for that use of the rise in passive, or why why passive is massive, right? So, and there's a reason why passive is massive and why ETF is rising at a staggering rate is of course, and it's really sad, but that's the way it is, many so-called supposedly active fund managers have been disappointing. So depending on the kind of statistical survey or analysis you take, 60, 70, 80% of the so-called active fund managers out there in the US, in Britain, in Europe, are actually slightly below the benchmark or the index, or very much below the index. Okay. So in that logic of cost control, many pension trustees are saying, wait a minute, I'm paying X basis point to an active UK equity or US bonds manager. He can barely duplicate the benchmark, or he's often below the benchmark. Why not shift some of that money towards cost-efficient, cheap, passive vehicles like ETFs? So that's been a massive driver, I think.
Okay, in terms of...
Yeah, can I mitigate a bit on the cost part? Yeah, because I think the cost part will be better or worse than other investments, depending on the size of the company. So let's say a huge pension fund will probably be better off in terms of costs investing into a passive but not ETF fund. So like a segregated fund will probably be cheaper than an ETF.
What's
for like
dedicated.
A dedicated fund.
Got it.
So passive managers would make dedicated funds, let's say above 100 million, let's say.
It's like a tailor-made.
You can make it, and that's going to be cheaper than an ETF.
Okay.
That would be using options and derivatives or other strategies to duplicate the index.
So that's one. But then if you only have 10 million to put into, let's say, some exotic market, you will probably be better off with an ETF, because nobody's going to make you a dedicated fund just for that. And then if you are like a final investor investing for your own future retirement,
401k.
Okay.
Then you would probably be better off with an ETF, because 50 basis points, it's cheap when you only have 1,000 euros or dollars to put into there.
So it really comes down to the volume that you're willing to invest.
Yeah, and the size of the companies who is doing that. Now there are ways of getting that cost down.
Yeah.
For a pension fund, for instance, because they could lend the ETFs. So in exchange for that, that comes, of course, with a counterparty risk, but in exchange for that, they would get extra fees, they would get money back, and that would take the cost of the ETF lower.
I was speaking with a gentleman earlier today, and he was saying that the quote was, ETFs or pension funds are a natural home for ETFs. And I think he was talking about the reason that it's easy to, they're very liquid, right now at least they're very liquid, and you can get money out, and maybe that deals with the payouts too as well. Are payouts a reason why pension funds use ETFs?
I don't believe payouts should be a reason to, that there are other reasons to hold them. I mean, and this liquidity thing, I mean, I can't get it straight, because how could an ETF be more liquid than the underlying assets? I mean, it depends, again, it depends how they are made, but if they are replicating the asset, they cannot be more liquid than the asset.
They can't be more, okay.
So, but there are reasons to hold the ETFs, like in a transition period, going from one manager to the other. Then you might, instead of not doing anything or remaining with a manager that you don't trust anymore, then holding an ETF could be a good way of investing. You can get in and out of them intraday, which you cannot do for an active or a passive fund, for that matter.
But for pension funds, right? They're supposed to be investing for a long time, right? If you have a bunch of pensioners who are going to retire in 40 years, 40 years is a long time to invest in something. Now, maybe they wouldn't hold that for the entire 40 years, but being able to trade intraday doesn't seem like something that would be an attractive quality. Or is that an attractive quality?
You're making a good point here, and a very good point actually, but there's been a blurring of the lines. So, in the old days, active was active, passive was passive, short term was short term, long term was long term. Things were clean and definitions were clear cut. sadly, or I don't know if it's good or bad, but we live in a gray world where the lines are being blurred. And I think, you know, the difference between short-term and long-term is less clear and compelling than it used to be. Just like I think we'll say later on why the difference between active and passive is not as clear-cut as it used to be. And so, for example, even though it is your fiduciary duty as a pension investor to be a very long-term asset owner, at the same time, being a long-term asset owner doesn't mean that on a daily or weekly or monthly basis, you don't have needs. And I think a great example is from your country. You're from the US, right?
I am.
So the very interesting example, and I think it also fits very nicely with what Adina was saying earlier, because of course, if you're a mid-size or even if you're a large American pension fund, right? So you would be buying stocks on Wall Street directly, or you'd be giving a huge mandate to the big, you know, asset management companies in the City of London or Wall Street to buy on your behalf billions in US equities, European bonds, etc. But there are some niche products. So for example, you know, even if you're a fairly large Canadian or American pension fund, you may not have the staff or the skills or the know-how to be an expert in Korean bonds or in Turkish equity, right? And sometimes you need to deploy capital. And by deploying capital, I mean buying or selling a lot of things, equities, bond, quickly. And in a market which is like an exotic market far away from home. And in those circumstances, passive strategies, options, derivatives, indexed funds, and ETFs, so the whole passive universe, allows you to operate quickly and nimbly. And there's a very interesting example, I think, that a year ago, President Trump was delivering a speech at the UN General Assembly, where I think he was saying something along the lines that he was going to bring fire and fury to the Korean Peninsula, right?
Okay.
And for the whole month of October of 2017, there was a free fall in South Korean, Cambodian, Vietnamese, Thai equities. Literally, they lost 25, 30, 40%. And in those circumstances of crisis, many people are petrified and they don't know what to do. And you have some bold pension investors or sovereign fund investors coming back to what Adina said earlier. They're not motivated by short-term fluctuations, they have a long-term plan. Because they're investing over 20, 30 years, for them a crisis could be an opportunity. So they looked at the Financial Times and the Wall Street Journal saying, oh my God, it's the end of the world, Korean Peninsula is going to burn, President Trump said that, blah, blah, blah. And they said, my God, on average, South Korean stocks lost 30% in 2 weeks. They're cheap. Yeah. Let me buy a bunch of them. Yeah. And I think there's one pension fund in particular, which is I think the Tennessee Public Pension, the largest public pension fund in Tennessee. They spent 2 weeks while everyone was selling massively, and the price were depressed. They were buying everything South Korean. So they bought every day for like 2-3 weeks. Yeah. They bought massively, indexed funds, stocks, shares, and ETFs, focusing on the South Korean equity, the KOSPI index. So, and guess what? 2 months later, the price has rallied, and they made a fortune.
So it's a strategy to have a kind of a hedge against these types of headline risks.
Yeah, it can work like that.
Yeah, or just the fact that one of the reasons also it's becoming more blurry between long-term and short-term is that the pension funds, even though they have a long-term horizon and a long duration, the regulation pushes them towards short-term constraints. So they always, even though they are, again, very long investors, they will have to watch their funding ratio at all times. So ETFs or passive or whatever are useful tools to get in and out of a market in the short term. So they do still have that need. Okay. And some of them, I don't know about the US, but certainly in France, for instance, some institutions cannot use derivatives, and some of them cannot go short.
That's a very good point.
So for those, they might want to buy a short ETF, which is a long position, but that will take them in the opposite side of the market.
That's a way to get around a regulation.
I think she raised a very crucial point, which is regulation and the impact of regulation. Because in essence, if you want to duplicate an index, if you want to copy a benchmark, to imitate a benchmark, there are many ways. And if you're a sophisticated, large investor, you can use options, derivatives, etc. But there are many countries where the regulator is very tough. And rightly or wrongly, countries like Japan or South Korea or even France, where the regulator would say that options, oh my God, it's risky, it's only speculative, it's only for hedge fund, for George Soros. Let me limit the leeway of pension funds and let me not allow them to buy too many options and derivatives. And so a way to circumvent the law or to get around regulation is say, look, ETFs, they're approved for individual retail investors. So they're super kosher, they're highly regulated, everything is very transparent. So instead of buying, for example, options and derivatives, I can take an off-the-shelf ETF, and it's also a way for a small or mid-size Italian, Japanese pension fund to deploy capital without being hindered by bureaucracy or regulation.
Yeah,
That's
but
very creative.
Except that it might come with some, it might backfire a bit because sometimes they don't behave like the inverse of the asset you think they would. Like if you want to go short equities, you might not get the inverse of the positive return of equities.
Okay, let's go down that route. I think indexing and benchmarks is very interesting, right? And I want to remind our listeners at home, or wherever they may be, to definitely ask questions. We have some questions from the audience, and I want to get to those in a second. But in terms of tracking error, this may have been where you're going, I'm not sure. Was it not?
No, but it's related somehow. Okay. So tracking error is something that, like volatility, investors are very much looking at, except that it's not a good measure of risk with respect to the benchmark. Okay. Just to give you an example, so the way that you compute tracking error is going to be the difference between your benchmark and whatever your fund or whatever is doing, squared, right? So you never know if your tracking error comes because you're overperforming or underperforming your benchmark. Or you would never want to limit the upside tracking error, right? So, but it's just something that people keep on looking at. If you, for an equity investor, just not holding, I think, 2 of the stocks in the benchmark will already take them to 5% tracking error. So it's so really ETFs will help you have a small tracking error with compared to the benchmark. Yeah. And if you ever want to go active, just don't give any, like tracking error constraints, but that's my...
Here's a question from the audience, unless you want to comment on that, Nick, as well.
I think tracking error has many definitions, and it can be used for many things. But to make a long story short, it can also be used to assess the performance of an active, right? Of an active portfolio manager.
Sure, sure.
And it's also the reason why, people are moving to passive and ETFs is that some of these supposedly active fund managers haven't delivered the tracking error they have advertised, if you will.
Yeah, maybe one way, other way of saying it is that, of course, you should consider the performance net of costs, basically. And when it comes to that, then you have your way of comparing your different ways of investing.
Right, yeah.
So one of the questions from the audience we have is you talk about AI content. Oh, that's a different one. Back to technology. Distributed ledgers, interesting, will affect the investment community. ETFs won't be exempt. What are you doing with blockchain research in your work? I don't know if this is the right question. It's very interesting. Here's a question from the audience. Scotiabank in Canada just purchased MD Management, a doctor's equity and bonds investment platform with pooled funds, the most well-managed offering of its kind in North America. The banks are not offering innovation, investors are not dumb. What innovation can you say you know about platforms and approaches which we know about? Is this?
I think we don't have to answer every question, but I think that raises, the question itself raises an interesting issue.
Sure.
Which is, innovation in finance or fintech is important. And everyone wants to be modern and innovative, but the technology or the ideas behind passive strategies or behind ETFs were actually born in the late 60s, early 70s at Wharton. And there's a professor called Barton Malkiel who I think is still teaches there at the age of 92, whatever. And he wrote a book in the early 70s called The Random Walk Around Wall Street. And he was analyzing basically why many active fund managers are in the end not proving to be as successful as advertised initially. And I think that started, that article and that book then, A Random Walk Around Wall Street, started the whole reflection around passive, which gave us 15, 20, 25 years later, ETFs. So what I'm coming at is innovation in finance, like in any other sector, is slow. So of course, if you're a big Canadian bank, it's easier to buy an innovative company, I guess like Adina's company, in 5 or 6 years, her company, which is very innovative, will be for sale, and a bigger player will come by it. But I'm coming at it, it's sometimes difficult to innovate internally. Because when you're big, when you're a big bank or a big fund management company, you have your processes, you have your habits, and it's difficult to think outside of the box. And that's why many of these innovations, including ETFs, passive strategies, were invented basically by entrepreneurs in the US or in Britain or in other parts of the world who wanted to use technology to think out of the box. And I think the trend has only started, I think, in finance. In the world of investment, many techs are maturing, and I think we're going to see more and more disruption, more and more products, including more sophisticated ETFs and more platforms that will allow people to combine, divide, slice and dice their investments and their risk management. And I think that's ultimately would empower pension board members, trustees, and just savers.
Well, on that note, so institutional investors such as pension funds might be seen as slow to move towards these new technologies. Are there questions they should ask themselves when considering jumping on board with any type of new platform or new product that you guys have seen that's definitely worked?
Yeah, they have to do their due diligence, right? Yeah. And I think there's a lot of crowd behavior, and I think that's dangerous because not all pension funds should invest like CalPERS, because they don't have the ability internally to actually do their due diligence on some of the investments they're making. They don't have the same liabilities. They don't have the same goals. So by all means, they should invest depending on their own possibilities.
Yeah, they all have requirements for their pensionees that
are going to be different.
Consistent.
Yeah, but I think also the future of ETFs, even though right now, let's say equity ETFs are the most widespread, and I heard that in the US there are no inflows into equity funds anymore, only ETF equities. So, but that's not, I believe, where the future lies. With ETFs, it's going to be easier to get access to factors. It's going to be easier to get access to smart beta strategies, to other ways of actually getting the returns out of the market.
Okay. All right. Well, this has been a great panel. Thank you, everybody, for joining us. Any final thoughts for the audience? We have about 15 seconds. Diversify, and make sure that you have the ability to pay out for your pensions.
Exactly, and watch out for maximum loss in capital.
Okay, all right. Thank you, everybody.
Thank you, Ryan.